Welcome to the discussion. Today, we're diving into Acadian Asset Management's insightful piece, There Are Idiots, 7 Pillars of Market Bubbles. It's a provocative title, and the content is equally compelling.
Indeed. The title itself sets a rather blunt yet accurate tone for the analysis of market bubbles.
It certainly grabs attention. The paper argues that bubbles aren't just about irrational exuberance, but are driven by a specific set of factors.
Precisely. It identifies 7 key pillars that consistently underpin speculative manias.
Let's start with the most attention-grabbing pillar. There are idiots. Look around. What's the significance of this seemingly cynical statement?
It's not just cynicism. It's a fundamental observation about market participants. The statement highlights the presence of uninformed or irrational investors whose actions can significantly impact market prices. There are varying perspectives on this. The efficient market hypothesis suggests these actions cancel out. The Grossman-Stiglitz view posits that rational traders profit from these idiots, and behavioral finance suggests that their actions can create and sustain bubbles.
So the idiots aren't necessarily irrelevant. They're a crucial element of the market dynamic, according to the behavioral finance perspective.
Exactly. Their actions, driven by factors like greed and a lack of understanding, can create significant distortions in asset pricing.
Let's move on to the second pillar. Everyone ought to be rich. This evokes the idea of widespread financial aspirations.
Absolutely. This pillar speaks to the utopian vision often associated with bubbles. The belief that everyone can and should achieve significant wealth fuels the demand for assets, often regardless of their intrinsic value. Raskob's 1929 article urging Americans to buy equities is a prime example of this mindset preceding a market crash.
It's a seductive narrative, promising easy riches, and it often blinds investors to the risks involved.
The third pillar, nobody knows anything, introduces the inherent uncertainty of market prediction. It emphasizes the limitations of forecasting future asset prices.
This challenges the notion of expert market prediction, doesn't it?
Precisely. It highlights the prevalence of charlatans who claim to possess certain knowledge, preying on the inherent uncertainty and desire for easy answers. The rise of crypto charlatans is a perfect contemporary example.
The fourth pillar, a fanatic is someone who can't change his mind and won't change the subject, introduces the role of unwavering belief.
This describes the dedicated believers, the maximalists, who relentlessly promote their chosen asset regardless of evidence to the contrary. Their unwavering conviction can fuel a bubble by spreading a consistently bullish message. Bitcoin maximalists are a clear example of this dynamic.
Their persistence in spreading their message, even in the face of setbacks, is a key driver of the bubble.
The fifth pillar, the more confusion, the better, highlights the role of complexity and obfuscation.
This suggests that a lack of transparency can actually be beneficial in creating a bubble.
Exactly. The inherent complexity of many assets, like Bitcoin, makes it difficult to assess their true value, allowing for inflated expectations to persist. The lack of understanding fuels the mystique and attracts investors.
Next, we have number go up, a simple yet powerful statement.
This captures the momentum-driven nature of bubbles. The simple fact that prices are rising encourages further investment, creating a self-reinforcing cycle. This is the FOMO effect, the fear of missing out.
It's a classic case of extrapolating past performance into the future, often ignoring underlying fundamentals.
Finally, this time is different, encapsulates the belief that current circumstances are unique and exempt from historical patterns.
This is a dangerous assumption, isn't it?
Extremely. It ignores the cyclical nature of market bubbles, leading investors to believe that past crashes are irrelevant to the present situation. This is a recurring theme throughout market history.
So these 7 pillars work together, creating a potent cocktail for market bubbles. The presence of uninformed investors, the allure of easy riches, the inherent uncertainty, the persistence of fanatics, the complexity of the asset, the momentum of rising prices, and the belief that this time is different all contribute to the formation and growth of a bubble.
Precisely. They're interconnected and mutually reinforcing, creating a powerful feedback loop that drives asset prices far beyond their fundamental value.
What are the practical implications of understanding these pillars? How can investors protect themselves from the allure of bubbles?
Understanding these pillars allows investors to identify potential bubbles early on. By recognizing the signs of irrational exuberance and the presence of these 7 factors, investors can make more informed decisions and avoid participating in potentially damaging speculative manias. A healthy dose of skepticism and a focus on fundamental analysis are crucial.
Does regulation play a role in mitigating the impact of these bubbles?
Regulation can certainly help, but it's not a silver bullet. Regulations can aim to increase transparency and reduce the opportunities for manipulation and fraud, but they can't eliminate human behavior. The inherent human desire for quick riches and the susceptibility to narratives of easy wealth remain powerful forces.
What about a long-term investment strategy? How does that factor into navigating these cyclical market events?
A long term perspective is crucial. Bubbles are inherently temporary, they eventually burst. Focusing on long term value creation and avoiding short term speculation is a key strategy for weathering these market storms. Disciplined investing, based on fundamental analysis and a long term horizon, is the best defense against the allure of bubbles.
So, in essence, the paper provides a framework for understanding the psychology and mechanics of market bubbles, highlighting the importance of critical thinking, skepticism, and a long-term investment strategy.
Exactly. It's a reminder that market cycles are inevitable, and understanding the underlying drivers of these cycles is crucial for successful long term investing.
That was a great discussion. Thank you for your insights.